If you have $750,000 or more sitting inside a traditional IRA or a traditional 401k right now, I need you to stop whatever else you are doing and watch this video from beginning to end. Because there is something coming in 2026 that the majority of retirees with large retirement accounts are completely unprepared for. And when I say completely unprepared, I do not mean they are a little behind on their planning. I mean they have no idea this is coming. They have never heard about it. Their neighbors have not warned them. Their kids have not brought it up at the dinner table. And in some cases, even their financial advisor has not sat them down and walked them through the full picture of what is about to happen. What is coming is a combination of forces that will force you to take out more money from your retirement accounts than you may want to, push your income into higher territory than it has ever been in retirement, and then trigger a Medicare premium increase that can literally double what you are paying for your health coverage almost overnight. We are talking about the 2026 RMD spike and the Medicare IRMAA, a trap that comes with it. And if you have a significant IRA balance, this is not a distant problem. This is something that could start affecting your wallet within the next 12 to 24 months. So stay right here, because by the end of this video, you are going to understand exactly what is happening, why it is happening, who it hits the hardest, and what you can do about it right now before 2026 arrives and the window for the best options starts closing. I'm Jason. Welcome to Jason Retires. This channel exists for one reason: to help regular hardworking Americans navigate retirement with clarity, confidence, and a plan that actually holds up in the real world. Not the textbook version of retirement. The real version. The one with tax surprises and healthcare costs and rules that nobody explained to you when you were busy saving all those decades. If you want more of that kind of honest, practical retirement content, go ahead and subscribe right now and hit the notification bell. We post new videos every single week, and the topics we cover are exactly the things that matter most when you are in or approaching retirement. Now let us get into this, because there is a lot to cover and every part of it matters. Let us start with required minimum distributions, because that is the engine driving everything we are going to talk about today. Required minimum distributions, which most people know as RMDs, are the amounts the IRS requires you to withdraw from your traditional IRA, traditional 401k, and most other tax-deferred retirement accounts once you reach a certain age. The government has been patient with you for decades. They let you contribute money before taxes, let it grow without being taxed, and deferred your tax bill all the way into retirement. But eventually, they want their share, and RMDs are how they collect it. You cannot leave that money in the account forever. At some point, you have to start taking it out and paying ordinary income tax on every dollar you withdraw. Now, the age at which RMDs begin has shifted in recent years. Under the Secure Act 2.0, which was signed into law in late 2022, the RMD starting age was pushed to 73 for people born between 1951 and 1959, and all the way to 75 for people born in 1960 or later. This was celebrated by many retirees as a win because it gave them more time to let their accounts grow and more flexibility in their planning. And in some ways, it is a benefit. But it also means that for people who delayed taking RMDs because of this rule change, the balances in their accounts kept growing. And now, when those RMDs do finally kick in, they are calculated on a much larger account balance. That is the setup for everything we are about to discuss. Here is how the RMD calculation works in simple terms. The IRS uses what is called the Uniform Lifetime Table, which is essentially a life expectancy factor assigned to each age. You take your account balance at the end of the previous year, divide it by the life expectancy factor for your current age, and the result is your required minimum distribution for that year. The life expectancy factor decreases each year as you get older, which means your required withdrawal as a percentage of your account goes up each year. At age 73, the factor is roughly 26.5, meaning you are required to withdraw about 3.8% of your balance. By age 80, that factor drops to 20, and the required withdrawal becomes 5%. By age 85, it is 16, and you are withdrawing over 6%. The older you get, the larger the percentage of your account you are forced to take out every year. Now let us put some real numbers on this. If you have $750,000 in your traditional IRA and you are 73 years old, your first RMD is approximately $28,300. If your balance has grown to $1 million, your RMD is roughly $37,700. If you have $1.2 million, which is not unusual for someone who saved consistently throughout a long career and benefited from decades of market growth, your RMD is approximately $45,000. And remember, this is on top of any Social Security income you are already receiving. So a retired couple where both spouses are collecting Social Security might already have $40,000 to $50,000 in Social Security income. And now they are adding $30,000, $40,000, or $50,000 in RMDs on top of that. Their combined income is suddenly $80,000, $90,000, or $100,000 or more. And that level of income has a very specific and very painful consequence when it comes to Medicare. This is where IRMAA enters the picture, and this is the part that blindsides people. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge added to your Medicare Part B and Part D premiums if your income exceeds certain thresholds. Medicare is not free in retirement. Most people pay a standard monthly premium for Part B, which covers doctor visits, outpatient care, and related services. For 2024, that standard Part B premium is $174.70 per month. But if your income is above the IRMAA threshold, you pay significantly more. And the thresholds are based on your income from 2 years prior, which means the income you report on your 2024 tax return will determine your Medicare premiums for 2026. That 2-year lag is critically important, and we will come back to it. Here is what the IRMAA brackets actually look like. For single filers in 2024, the standard premium applies to those earning up to $85,000. Once your income crosses $85,000, you enter the first IRMAA tier, and your Part B premium jumps to $245.90 per month. Cross $107,000, and you are in the second tier at $350.90. At $160,000, you move to the third tier at $499.85. And at $500,000 and above, the top tier costs $594 per month. For married couples filing jointly, those thresholds are roughly doubled, but only to a point. And the way income gets calculated means that many retirees with large IRA balances cross multiple thresholds in a single year when their RMDs kick in. And remember, this is just Part B. IRMAA also applies to Part D prescription drug premiums, adding additional surcharges at each tier on top of whatever your specific plan costs. So let us bring this to life with a real scenario. Let us take a retired couple, both age 74. Call them David and Susan. David gets $2,300 a month from Social Security. Susan gets $1,400 a month. Together, that is $3,700 a month, or $44,400 per year in Social Security income. Now, Social Security income is not fully taxable. Up to 85% of Social Security benefits can be included in your taxable income if your combined income is high enough. But for the purpose of IRMAA, Medicare uses something called Modified Adjusted Gross Income, which includes 100% of your Social Security benefits plus all other income. So David and Susan's $44,400 in Social Security is fully counted toward their IRMAA calculation. Now add their RMDs. They have a combined IRA balance of $1,100,000. At age 74, their RMDs total approximately $42,000 for the year. So their modified adjusted gross income for IRMAA purposes is $44,400 plus $42,000, which is $86,400. That is just barely over the $85,000 threshold for married couples filing jointly. Wait, actually for married filers, the first IRMAA tier in 2024 begins at $170,000, so they might be fine at this level. But if their combined IRA balance is $1.5 million or higher, or if one of them has a pension, or if they have interest and dividend income from a taxable brokerage account, that income pushes them over the threshold and the surcharges begin. And here is where the 2026 timing becomes so critical. Because IRMAA is based on income from 2 years prior, the income you have in 2024 determines your 2026 Medicare premiums. If your RMDs are kicking in for the first time in 2024, or if your balance has grown significantly and your 2024 RMD is much larger than previous years, that spike in income will show up in your Medicare bill in 2026. And because many retirees do not track the IRMAA thresholds closely, and because the 2-year delay creates a disconnect between when the income happens and when the Medicare bill arrives, the surcharge often feels like it comes out of nowhere. You think your Medicare situation is stable. You are used to paying a certain amount. And then January 2026 arrives, and your Medicare premium statement shows a number that is dramatically higher than you expected. There is also a broader structural reason why 2026 is a particularly significant year for many retirees with large IRA balances. The Tax Cuts and Jobs Act of 2017 brought with it lower individual income tax rates and higher standard deductions. Those provisions are currently scheduled to expire at the end of 2025. If Congress does not act to extend them, and as of the most current legislative outlook that remains uncertain, the tax brackets will revert to their pre-2018 levels in 2026. That means higher income tax rates across the board. So a retiree who is already dealing with larger RMDs hitting their income will also potentially be facing higher tax rates on every dollar of that RMD income starting in 2026. The 1-2 punch of larger required withdrawals and higher tax rates on those withdrawals is what many retirement planners are referring to when they talk about the 2026 problem for IRA holders. Let us also talk about what happens to your Social Security taxation when your income rises due to RMDs, because this is another layer that most people do not think about until it hits them. Up to 85% of your Social Security benefits are subject to federal income tax if your combined income exceeds $34,000 as a single filer or $44,000 as a married couple filing jointly. These thresholds have not been adjusted for inflation since they were established back in the 1980s. That means every year, more and more retirees are pushed into the territory where their Social Security is taxed, simply due to the math of income growth. When your RMDs push your combined income well above these thresholds, you are now paying income tax on up to 85 cents of every dollar of Social Security you receive. For a couple with $44,000 in Social Security income, that means up to $37,400 of their Social Security is taxable. Add that to their RMD income, and you can see how quickly taxable income climbs to levels that trigger serious IRMAA surcharges. Now let us talk strategy, because this is the part that actually matters. Understanding the problem is important, but what you do with that understanding is what determines whether 2026 is a crisis or just another manageable year in your retirement plan. The most powerful strategy available to people in this situation is the Roth conversion. A Roth conversion means you take money out of your traditional IRA, pay income tax on it now, and move it into a Roth IRA. Money in a Roth IRA grows tax-free. Withdrawals from a Roth IRA in retirement are tax-free. And here is the big one for this conversation. Roth IRAs are not subject to required minimum distributions during your lifetime. So every dollar you convert from a traditional IRA to a Roth IRA reduces your future RMD. If you convert enough over time, you can dramatically reduce or even nearly eliminate the RMDs that would otherwise push you into IRMAA territory. The key is to do these conversions strategically during the years when your income is lower, ideally in the gap between when you retire and when your Social Security and RMDs kick in. That window is sometimes called the Roth conversion sweet spot, and for many retirees, it is one of the most valuable planning opportunities available. For example, if you retire at 65 and delay Social Security until 70, those 5 years between 65 and 70 represent a period of potentially very low taxable income. If you have $750,000 or more in a traditional IRA, converting even $100,000 to $150,000 during each of those 5 years can make a meaningful dent in your future RMD exposure. Yes, you pay taxes on those conversions now, but you pay them at a lower rate, and you eliminate the future tax liability and the future IRMAA risk that comes with it. According to analysis from retirement planning researchers, including those at the Kitches Financial Planning blog and the American College of Financial Services, strategic Roth conversions are consistently ranked among the highest impact moves available to retirees with large, traditional account balances. The second strategy worth understanding is qualified charitable distributions, commonly called QCDs. If you are 70 and a half or older, you are allowed to make direct transfers from your traditional IRA to a qualified charity, up to $105,000 per year in 2024, and that amount is indexed to inflation going forward. The amount transferred through a QCD counts toward your required minimum distribution for the year, but it does not get included in your adjusted gross income. This is significant because it means you satisfy part or all of your RMD obligation without that money ever showing up as taxable income. If you are charitably inclined anyway, this is essentially a way to give to causes you care about while simultaneously reducing your taxable income, reducing your IRMAA exposure, and reducing the taxation of your Social Security benefits. It is one of the cleanest and most underutilized tools in the retirement tax planning toolbox. The third strategy involves timing your income carefully across calendar years to stay below IRMAA thresholds when possible. Because Medicare IRMAA is calculated based on your income in a specific calendar year, retirees who have flexibility in when they take certain distributions or recognize certain income can sometimes manage their income deliberately to stay below threshold levels. This is sometimes called IRMAA bracket management, and it requires paying close attention to what income you are expecting in each year and making deliberate decisions about the timing of discretionary withdrawals, Roth conversions, and other income events. If you do end up crossing an IRMAA threshold due to a one-time income event, like a large Roth conversion, a property sale, or a business transaction, you can actually appeal your IRMAA surcharge if your income has since dropped back to a lower level. This is done using a form called SSA 44, and it allows you to request that Medicare use a more recent year's income if you have experienced what the Social Security Administration calls a life-changing event. This does not cover every situation, but it is worth knowing about because many retirees pay IRMAA surcharges in years when they could have appealed and potentially had them reduced or eliminated. The fourth strategy is to work with a financial advisor who specifically understands RMD planning, Roth conversion strategy, and IRMAA management. Not every financial advisor has deep expertise in all three of these areas simultaneously. This is a niche within retirement planning that requires coordinating tax planning, investment management, and Medicare planning all together. A fee-only financial planner, or a CPA with retirement income specialization, can help you model out the different scenarios and make decisions that are optimized across all of these dimensions, rather than just looking at one piece at a time. Now, there is one more thing I want to address before we close, and it is something that comes up a lot in the comments when we talk about topics like this. Some people say, well, if I have $750,000 or $1 million saved, these are good problems to have. And in one sense, that is true. Having a large retirement nest egg is a great position to be in, but the widow penalty we discussed in a previous video and the RMD-IRMAA trap we have been talking about today are both examples of the same underlying phenomenon. The rules of the retirement income system were not designed with your specific situation in mind. They were designed at a policy level, with thresholds and phase-outs and timing rules that create real financial pain for real people who did everything right. You saved diligently, you invested wisely, you deferred gratification. And now the system has a set of mechanics that can significantly reduce the value of all that hard work if you do not understand those mechanics and plan around them. That is exactly why this channel exists. Not to scare you, not to make retirement seem impossible, but to make sure you have the information you need to make smart, confident decisions. Because the people who understand these rules are the ones who can act on them proactively. And the people who do not understand them are the ones who open a Medicare statement in January 2026 and wonder why their premiums doubled. So here is what I want you to do right now. First, find out what your projected RMDs will be for the next 5 to 10 years. Your IRA custodian can help you with this, or you can use an RMD calculator online. Look at what those distributions will do to your combined annual income. Then look at the IRMAA thresholds and see where your income lands. If you are close to a threshold or already above one, that is a signal that you need a proactive strategy in place before 2026 arrives. Second, if you have not already had a conversation about Roth conversions, have that conversation now, not next year. Now. Because the value of a Roth conversion is highest when you do it before the tax rates potentially go up in 2026 and before your RMDs get even larger. Third, if you're charitably inclined and you are over 70 and a half, look into qualified charitable distributions as a way to satisfy RMD obligations without adding to your taxable income. And fourth, if you do not have a financial advisor who is specifically looking at RMD management, IRMAA planning, and Roth conversion strategy as an integrated whole, it might be time to find one who does. I want to hear from you now. Did you know about the 2-year look-back that connects your 2024 income to your 2026 Medicare premiums? Were you aware that your RMDs could push you into IRMAA territory? Drop a comment below and tell me where you are in this picture. Are you already dealing with IRMAA surcharges? Are you planning Roth conversions? Are you just starting to think about this? Your comments help me understand what topics to go deeper on, and they help other viewers who are in similar situations feel less alone in navigating all of this. If this video gave you something valuable, please share it. Send it to a friend, a sibling, a parent, anyone you know who has a significant traditional IRA balance and might not be aware of what is coming in 2026. Sharing this video could literally save them thousands of dollars. That is not hyperbole. That is just math. And if you are not subscribed to Jason Retires yet, subscribe right now. Every week we bring you content that is focused on the real financial challenges of retirement in America. And we are not going to stop until every person who worked hard and saved hard has the information they need to protect what they built. Thank you for being here. Thank you for watching all the way through. I will see you in the next one.